Welcome back to Stablecoin House, everybody. I'm excited to be sitting here with Pierre of STS Digital, and we're going to dive into the trends in the crypto options markets. Pierre, thanks for taking the time to sit down. I appreciate it.
Thanks for having me.
Do you want to start with a quick introduction about yourself and then maybe a quick introduction about STS just to set the context for everybody?
Yeah, of course. So, hi everyone. Thanks for being here. So about myself, so I started my career in TradFi. I worked for 7 years at Goldman in London in the city. I was doing cross-asset derivative sales and structuring for 7 years, so way too long, it turns out. Weirdly, it was cross-asset, but crypto was not really a thing, or at least was not, the banks weren't able to touch it. It was a fun product, but ultimately the culture of the industry was really not, what I wanted for my career. And so then I moved to the family office of a prominent German investor and entrepreneur who was very deep in Bitcoin and Bitcoin mining, and also in a lot of other esoteric topic, including longevity. So funnily enough, I worked for 4 years as the head of finance of one of his longevity biotech company, and as the bear market hit the whole deep tech complex, a lot of the very, very wealthy crypto moguls of the space became investors actually in my company because they were very excited by the longevity space specifically. And so
when you make a ton of money, you then need to figure out how to live long enough to spend the ton of money that you've made.
Exactly. It was a lot of that actually. And so it was very, very exciting but also very difficult. If you think a bear market is hard in crypto, wait until you see a 4 years bear market in biotech, and then you realize that we have it pretty good. But yeah, so after 4 years, one of my best friends had actually created STS Digital, and I helped him raise this seed round, brought him a strategic investor that I had met from my previous job, and then jumped in and took over the BD part of the business. I'm now running globally the whole sales effort, and also taking care of investors relations. So it's everything that's external facing.
Yep. You're the face of STS.
Yeah. Well, I think
that's why you're sitting here.
There's a few others that might say that they're also the face. But yeah, no, definitely one of the public faces. And about STS, it's very shortly, like we're probably one of the most active OTC options market maker in crypto, solely focused on crypto. We buy and sell. We make markets on options on more than 500 different coins.
500 coins.
Yeah, that's quite a lot. We probably have the largest universe of any of the players out there. The company was founded by very, very experienced hedge funds and TradFi options traders, so with a very deep expertise in the space. It's the only reason why I joined, because I knew I knew what they were doing. And so that's really like where we're the most well known, and we have about 200 clients. We have automated the whole process of pricing and trading options, so people can trade via UX, even connect to APIs if they're like banks or exchanges. So we can actually feed all the prices through and kind of have this very, very powerful distribution channels.
Yep.
And then as an aside, our second big business units is around spot market making, so a bit more traditional, like helping token list and helping them after listing with the exchanges, conversations, etc. But really where we are most well known for is on the option side of things, and I guess that's where we have probably the best insights on the market in general.
Can we dive into that a little bit? So I think options markets are certainly not new things, right? But in like crypto as an asset class, especially since the early days of crypto, has been very, very much a spot market, right? Where those volumes have dominated from kind of the Bitcoin white paper into kind of more modern times. What does kind of the size and structure of the crypto spot market look like now?
Options, you mean?
Options, sorry.
Yeah, so it's an interesting point. Like interestingly, as you said, crypto has been dominated by spot and also by perps.
Yep.
I think one of the great genius stroke of Arthur Hayes was basically making that product perps, that was already used in gold in Hong Kong, popular for crypto. And I think as a result, options have historically suffered a little bit in comparison. So today, the size of the options market in crypto, when you include exchange, where we have very good data, and OTC, which is a lot harder to actually figure out. But overall, I think the best estimation we came up with is that the options market represents only 5% of the spot market.
Yep.
And what's interesting is in TradFi, the options market is roughly on FX is about the same size as the spot market, and in equities is actually multiple size bigger.
Where do you think this goes? Sorry to interrupt, but where do you think this goes longer term? Do options stay a small fraction of spots? Do they equal spots? Do they exceed spots?
It's interesting. I think, we at STS, our sort of take is that there's going to be a catch up, and it's already happening. We're seeing it ourselves. I mean, in terms of the average volumes that we process per month, we've observed we 4x roughly like our volumes from any given month this year to what it was last year. It will not have escaped you that Robinhood entered the market, and they haven't announced any program on options yet. But as you know, Robinhood is famous for having popularized options with retail traders, and we think that's a sign of what potentially is to come.
Yep.
And we can also see from our conversations with some of the big hedge funds, some of the household names, which last year were barely able to touch spots, that now more and more are having or in the process of being approved to actually trade options on coins themselves.
Very cool.
So we're definitely going to see a catch up. We're already seeing fast growing volumes.
Yep.
And I think ultimately we expect that market to grow 10x within the next 2 to 3 years. That's our assumptions, and we want to be really at the nexus of that.
Very cool. Exchanges, I think, including Deribit, right, have really struggled to do options well on even top 5 coins, maybe even top 2 coins, basically, right outside of those.
Yeah.
And you guys are doing hundreds of coins. How are you able to do market making on options for hundreds of coins where people like Deribit struggle with 2 or 5? Yeah,
so it's an interesting thing, and it's
without giving away the secret sauce.
No, but there's a variety of reasons, but a lot of it boils down to the model that exchanges are following when they deal with options. They typically go for the try and tested central limit order book model, which has worked really well for spot and for perps. But what it does mean is it forces market maker to actually populate all the order books with liquidity and actionable prices. But if you think about options, you have a token, and then you have puts and calls, and then you have several maturities, right? And let's say 10, and then you have maybe 30 potential strikes, right? And so that's so for a given coin, you could you easily end up with 500 potential different order books that you have to take care of.
Wow.
Each one of them with actionable prices. Now you multiply that by a number of coin. That's already a crazy amount of the order books. And now you add the fact that all of the exchange want to have their own Me Too option platform.
Of course they do.
And it becomes impossible for market makers to service all of these order books properly without, without being picked off or without, making mistakes on the price and things like that, or struggling to actually just generally populate all these order books, right? So, so the net result of that is that Deribit has only really been successful at having liquid order books and fairly long maturity profiles for BTC and ETH, where they are the undisputed dominant players. But even for Solana, if you go on Deribit, you only have max 3 months maturity, and the bid offer are very, very wide. And as soon as you want to trade size, it becomes impossible. You have to go to the alternative model is a more RFQ-based model. And so instead of asking the dealers to quote large, huge amount of order books, you basically go and tell them, I'm interested in this coin, this option, this maturity, this strike. And then they tell you, we can give you that price for this amount. And so that RFQ model, whether a single dealer or inter-dealer, is where we think the market is actually going to go for options outside of the top 5, really. And so in doing that, becoming more like the FX market, where actually an inter-dealer RFQ model is what dominates. So that's kind of the direction that we're seeing in the market. There is a certain amount of disagreement around players around this. Some exchanges are hell-bent on building their own central limit order books.
Exchanges are never opinionated. What are you talking about?
And some others working with us are actually favoring an RFQ model, and potentially we feel that this is where the market on our coin can actually become exchange based. So that's kind of a little bit one of the reasons behind it.
Very cool. I think at EthCC, there's always a big general argument outside of options, outside of spot, outside of everything on like CeFi versus DeFi, right? And a lot of builders are always very, very DeFi heavy, very heavy permissionless, all sorts of things. Why do you think that there isn't more kind of DeFi options activity, and why do you think it's more market makers and folks like that?
Yeah, it's definitely been challenging to create successful on-chain options protocol.
Yep.
The last time I checked, using the stats on DeFi Llama, I think the size of the on-chain options market is about 1% of the size of the off-chain, CeFi options market. And so, I mean, there's a few, successful protocols out there. I think, people like Deriv or Ithaca and a few others have actually done a good job. But I see two main limitations, which I think have historically impacted on-chain options. The first one is that individual smart contracts make it extremely difficult to, if you're a dealer or a market maker in option, to do cross-margining of options in the background. So very, very simply to net all of the exposures and all of the collateral margins that you have in the back. And sort of, and so basically you have to keep them all gross at the smart contract level, which is very, very capital inefficient, and means that net it is much less expensive to buy options and to trade options if you do it on CeFi than if you do it on DeFi.
Yep.
So we're seeing some interesting hybrids now that are being launched, which use a DeFi interface, but in the back end actually do the cross margining off chain.
Yep.
So so these kind of hybrids may have more success, but they're still pretty early days. So that's one thing. And then the second thing is the type of trader that actually dwells on chain is oftentimes more interested by highly volatile coins or understands perps, but not options. The really serious options traders, there's a few notable exceptions, but are rarely on chain. They're mostly off chain, trading on derivatives or doing OTC trades. They're not necessarily equipped or even have a mandate to go in the rabbit hole and actually trade on chain. So I think it's this combination of factors.
You mentioned a lot of the on-chain traders understand perps well, but not options. Can you just break down a quick options versus perps, pros, cons for everybody?
Yeah, for sure. So, what perps have for themselves is that they're simple to understand. It's really just a linear payoff, and it's just, a multiplication factor. You have a liquidation level, and that's kind of it, right? So it's basically, if you get it right, you will do well. If you don't, you'll get wrecked. And I think that's very well understood. But there's a lot of issues with that model. The first one is, the perps prices can be manipulated, and they often are. If you look at the prices actually that is used for perps, you will notice that it's actually significantly different than the actual spot price of the assets. You will notice that in case of high volatility, the movements on the price for a perp is actually significantly more important than for the spot price of the same token, meaning there are more liquidations. So you obviously have the liquidation risk, which is massive. And then you can end up paying enormous amounts of money and almost like hidden fees, not just on like the level at which you get liquidated by the exchange, but also because of the funding spread, right? So when the market is really frothy and everyone is on the same way, you end up paying through the nose most of the time. But I think the biggest risk is the liquidation problem.
Yep.
And that's actually the great thing with options is you don't have any of that liquidation risk. You can be wrong short term and right long term. And so put it this way, when I have option trades on, I actually sleep a lot better than when I have perps trades on. And also ultimately both enable you to actually take leverage. The leverage on an option is not constant. And oftentimes, people don't really think in terms of what's the actual leverage at any given point in time, even though there are implicit ways of finding it. But options, give you leverage without the liquidation risk, and also less prone to manipulation, at least on the underlying price. So I think very schematically, that's conceptually the differences.
What do you think are the strongest use cases right now for options trading? Like, it's only 5% of spot. We think it's going to 10x. Like, what are the use cases that are driving that growth?
Yeah, so there's quite a few different things. So you have obviously like the directional, purely speculative plays. Mm-hmm. Oftentimes, it's individual investors or hedge funds, liquid funds that have a mandate to trade options. They they buy and sell puts and calls. It's very ad hoc, very tactical. Tends to be pretty short dated trades. There is a much more systematic source of flow with, for instance, protocols, big treasuries, big foundations, or even founders that are sitting on a lot of their own tokens that can't sell, won't sell their token, but effectively don't want them to stay idle. And so they typically sell out of the money call options, generate hard dollars on these tokens. And if they do it well, the risk of actually being exercised and having to sell your token is fairly low. And if it happens, it usually means that the token has rallied. So, you can also see, as a disciplined way of taking profits on a small part of your token treasury. So that's probably the most common and the most systematic way that people have been using options in crypto, called overriding. A third one is coming more from the spot market making side. So a lot of the contracts on spot market making are actually structured as a convertible loan, meaning a loan with an embedded option in it. And so that's obviously for us a very big source of option flow, and these are usually pretty big transactions. They are, they don't happen as often. They're more strategic, but when they do, it's usually pretty big contracts. And then you see also a new emerging cases is the use of structured products, more from financial investors, oftentimes distributed through asset managers, just to take exposure and generate yields on their assets through selling volatility on crypto. So I guess there's also hedging. If you have a big allocation of tokens, you may want to buy protection.
Yep.
Tends to be pretty expensive. So I guess a lot of people check it, but they don't necessarily pull the trigger. But that's also an obvious use case. Yeah.
Maybe a kind of a linked question that goes alongside that, right? As these use cases drive new growth, in theory, it also means it's going to drive new entrants, right? That are going to be fueling that growth.
Yeah.
So for people who are getting into options markets and for beginners, kind of what are the common mistakes that people should be avoiding? How do you not lose all your money?
Yeah, it's interesting, and there's, I guess, one of the most common mistake I think that people do is they only think in terms of spot price, and they don't think in terms of volatility. At its core, an option price is very, very strongly correlated to the implied volatility that is used to price the options, to such an extent actually that you can quote an option price based, or you can quote it implied volatility based. Some people actually just quote an implied volatility, right? So that's actually the most important parameter. And a lot of people that come from the spot world or the perps world are only thinking in terms of spot and never in terms of volatility. And if you combine that, so a classic way to lose money, and I raise my hand because I've actually lost money doing this, is the market has already started rallying. You're late. You don't have enough. And so you think, I'm going to juice up my return and I'm going to buy some upside calls. Because the market has already rallied, the volatility is elevated already, right? It's priced into the option, the market is more volatile, so the premiums are more expensive. And the spot is already fairly high.
Yep.
So if you actually end up buying at that level, you're buying high spot and you're buying elevated volatility. And then if the market even stays stable, right, the volatility compresses, and so your option loses value, even if the spot is just not moving. And if anything, the less it's moving, the more volatility compresses, and the more your option position is actually declining.
Yep.
And so the big mistake is oftentimes to chase rallies just buying calls. And if anything, the best strategy, this bull market, which has been a weird bull market, as everybody knows, was to fade the pumps on our coins and instead of buying calls was to sell calls. So obviously selling calls is risky.
Yep.
You know, if the coin goes to infinite, you have a problem. But if you're, let's say, a treasury which anyway is sitting on a massive amount of coins that it can't sell,
Yep.
or that they, you know, it can only sell like bit by bit. Well, you know, a great strategy is when a pump has happened to effectively sell on an amount that they're comfortable with calls and just monetize that massive volatility premium that's in there.
Yep.
And more often than not, the market is retracing, and you don't get exercise, and you just really kind of like made a lot of money on those calls. So again, like it's called covered calls because you have the underlier. I'm not telling people to actually just sell naked calls. It's a dangerous strategy that can really, really turn badly if you do it. Most of the platforms won't let you do it anyway, you know, for obvious reasons, unless it's funded, or unless you have those underliers. So that's, I guess it's one of the biggest mistakes. And in general, I think people are always very afraid of selling options because, you know, your loss can exceed the premium that you get from actually selling the option. But in many cases, it's the best strategy, right? So let's just say that, you know, I'm just going to take that example again where, you know, you're in this situation where a token has already rallied a bit, the volatility is elevated, the spot is at a level that is high, but you're still confident it's going to keep rallying. You're much better off actually, in this case, selling a put, right? And then you monetize the volatility premium. And if the spot goes higher, the value of the put that you've sold collapses, and you can immediately unwind the position, and you've clocked that profit, and you're out. And so, again, that's the risk that come into it. And you know, if the market really goes south, if you're really wrong, then you can end up having to pay a lot more than what you've actually gotten from the premium.
Yep.
But from a technical standpoint and from a risk reward standpoint, you're much more likely to make money doing this than just buying these expensive calls, the negative volatility level. So I guess that's really one important point, and I think that's probably the number one mistake that people make. And then maybe sort of like a second point is buying outright options is very expensive. So let's say you just buy outright calls on an already very volatile token, you end up paying a lot of premium.
Yep.
And so sometimes it's much better to buy spreads. So you buy a call with volatility at a strike at $100, and then you cap it somewhere at like $300, and then you can increase the notional a lot more.
Yep.
And because you're buying volatility at $100, but you're selling volatility at $300.
Yep.
Your net volatility exposure is lower. Okay. And so you're effectively not as overpaying for volatility as you would be if you were just buying that naked call on the upside. And so spreads are often a very elegant way of getting big leverage on the upside, even in a pretty volatile market, without being that affected by volatility and the corollary of volatility as you get closer to expiry, which is decay. I think just these are the two, I guess, main points.
I think those are very helpful. We'll end maybe on my favorite question of all time, because I think builder energy is always very contagious. What are you most excited about for the rest of this year or the coming year, however you think about your time intervals?
Yeah, I think, you know, as I mentioned, we think the market is on the cusp of explosive growth. And in order for us to be able to service that demand, we've built for the last 2 years a fully automated pricing and trading engine.
Very cool.
And a UX and even an API that you can connect on and effectively get access to, initially, I think 30 coins, but the idea is to have as much as 200 coins. And so basically create an options factory where you can price, trade, risk manage, and exit automatically through our platforms.
That's awesome.
In a way that hasn't been done before in crypto and on an industrial scale. We ultimately want to be the options factory of the crypto world, and the product is ready and we're rolling it out now, and I think it's going to be very exciting.
Well, with the experience that you have on options trading and that STS has, it sounds like a reality that may soon exist. Very cool. Thanks. Do you want to take some questions from the audience? Or?
Sure. Yes, if there are questions.
Does anybody want to talk about trading?
So how do you think there is an adoption? Can you also like using options to generate yields also as an assets? Right?
Yeah.
So how do you think What is your thoughts on does options get on chain? Like, currently we see a lot of the liquidity is driven by off chain.
Yeah.
Like, do you think there will be a flow of liquidity going on chain?
I think there's definitely protocols that recently have generated very good volumes. I was mentioning a few earlier. So the liquidity on-chain for option is definitely increasing. And I think it will continue to increase, especially if there are innovations, how to say. You need to separate, I think, the UX from the back end, and especially for the market makers. So the market makers need to be able to net, to do cross margining and net the collateral. So far, and I mean, I might be wrong, but no one has managed to do it really efficiently, purely on chain. But we've seen protocols that use kind of like a hybrid model, and these we think could be a lot more successful potentially. So I guess that's that's kind of our sense of where the market is heading, and so we'll see. Yeah.
Maybe more like an RFQ on chain, something like that. That's more sensible because anyone can quote certain price, and like somebody on the other side can actually fulfill that. You don't have to go through the order book to actually fulfill that.
I definitely think that for altcoins, the RFQ is the way to go. Again, it's you need to make the life of the liquidity providers in the background easier, and there's always that hurdle rate that people like us have in terms of, is it more economical or more expensive to quote online or to deploy our capital off chain? So yes, the RFQ model definitely helps already.
Cool. We'll take maybe one last question.
So considering algorithmic on-chain options fail with like driven finance, do you think they will ever come back?
As I said, I think it's we've seen some protocols that are doing quite well on more simple type of strategies. Like you have systematic calls overwriting and things like that. So I don't necessarily think that they failed completely, and I think if anything, these protocols have been successful in generating each like more than $1 billion of notional traded, which is not that much compared to spot, but it's still actually quite significant on the option side of things. So they may do a comeback, but I think the best solution is probably going to be this type of hybrid model, and which is quite new and emerging. Yeah.
Cool. Thanks, Pierre. We'll wrap this, and then you guys can do it. Thanks, Pierre.
Thanks a lot. Thank you for having me. Hey, thanks.
Nice.
Hope you liked it.
Yeah.
Yes. Yes. Oh, yeah.
We can also take a picture, but.